In this video, we are going to create a simple feasibility study or business plan. The goal is to see whether the project is feasible or not. We are required to forecast the first 5 years of operations. As you can recall from the class, at the end of the study, if the net present value is positive, it is feasible. If it is negative, the project is not feasible, and if it is zero, then it yields a neutral view regarding the project. As stated in class, looking at the feasibility or viability of a project depends on its nature. If it is a charity project, for instance, we usually do not expect the NPV to be positive, but from a purely commercial point of view, a project is feasible only when its net present value is positive. The new project or extension must yield an added value for the company. It might have effect on another entity within the company or holding company. Now, we start by opening the file to look at the given data. As you can see, it is the same example like we had in class except for a few variations. First, we have the company name and its nature or industry. We know that the company trades two products, laptops and desktops. We have the cost of each as well as the selling price. We assume that all these numbers don't change over time. We have the first year sales forecasting for both products. Sales are expected to double every year. So, we don't have fractions, as it should not be in our example because computers do not sell in fractions. Thus, for the first year it is 200, for the second 400, the third 800 and so on. From the second year onwards, sales are equal to the previous year multiplied by 2. Our accounts receivables under current assets in the balance sheet are equal to 20% of total sales. We have the expected purchases. Same concept as before, but here our accounts payable will be equal to 75% of total yearly purchases. The company pays €12,000 rent per year, and it is paid in advance. This is an important assumption. If it was not mentioned, we just record rent expense at the year-end in the income statement. But here, since it is mentioned, we have to include it in the balance sheet also as prepaid rent under current assets. Remember, as long as it is not due, it is an asset. I repeat the example we used in class. The concept of prepaid charge is the following: suppose you give your friend €100 to paint your wall. You agree that as long as he has not finished painting, you can get your money back. In this case, the 100 is still your asset. Once he paints the wall, the charge is due, and the 100 is incurred as painting expense. At this stage, you cannot get your 100 back, so it is not an asset anymore and must be removed from the assets in the balance sheet. Usually, prepaid rent is only usable when the feasibility study shows monthly, quarterly or semi-annual variations because in this case, you can see the changes in the advance payments. Anyways, we keep it as a valid assumption in our example. Now, we move forward with the assumptions. The initial contract is for 3 years, and the rent will increase by 10% after year 3. So, for the 4th and 5th years, the rent will be equal to $12,000 plus 10%, which is $1,200, and the total rent becomes $13,200 after the 3rd year. The company has 3 employees, a manager, and 2 salespeople. We have their monthly salaries. Now, please look carefully. You see that although these two numbers are the same, and same for the purchases and also for sales, we still have them in separate cells. The reason is that it is always better to separate them, to make them independent of one another. So, later in the future, if you want to change one of them to see its marginal effect on the study, you can. Otherwise, they are dependent and you cannot see the important marginal changes for an increase or decrease in the sales of laptops or desktops alone. And so for the purchases, and the sales team, because we can change one position and give a different salary for each. Each employee is paid 10% in bonus at the end of the year. So, for example, here we have the monthly salary. We multiply it by 12 to get the yearly salary of $48,000. Then we add 10% or $4,800 to get a total of $52,800 of yearly remuneration for this employee. The company bought a car for $10,000 at the beginning of the year. The depreciation rate is given as 20%, and we apply the straight line method. This means that the car depreciates by 2,000 each year. The car will depreciate in value in the first by 2,000, the second by the same. This makes the accumulated depreciation at the end of the second year as 4,000. You divide 1 by the depreciation rate to get the useful life of the car in years. In our case, it is 5 years, the life of the study. In 5 years, the net value of the car on our balance sheet will be 0. The company has a capital of 50,000. We assume no loans in our study. Also, the required registration costs are 4,000 at the beginning of the study. The tax rate is 20% flat rate. It does not change over years. And, that is all with the assumptions. Apparently, we have a little annoying fields mixed with text and numbers that we need in the study. You see, this is a number. Easy to deal with later on. This a number, and this is another. All numbers. But now, it is a number in a mixed field. Again, number in a mixed field. It is always better to keep all dynamic. It is much more efficient to have one sheet to handle than multiple sheets and fields. This becomes a template that is very easy to use. So, here, instead of having this static value, we can convert it into dynamic, and let us see the advantage of the dynamic approach. Consider the case where we later need to use this number over many years. We change it to absolute reference using the dollar sign. Then, we copy to the right. Now, whenever we change the value under assumptions, everything changes. On the other hand, consider that we have to use the 20% rate multiplied by some value. Later, if we want to change this to 25%, we have to change the other fields manually. We change to 25%, and copy and paste again. This would be waste of time, and cause mostly mistakes. To overcome this problem, we create additional dynamic fields or cells. First action, copy the data into a separate sheet, so we have the initial assumptions untouched. It is important to leave a copy of the initial assumptions we have so it can serve as a reference later on. This can be accomplished by copying and pasting all cells, or like I prefer, we copy the sheet. Right-click on the sheet, move or copy from the menu. We tick Create a Copy and click OK. We rename the sheet to Assumptions, and start the modification process. We start by creating a new field for the sales on accounts or accounts receivables. Then, we move to purchases on accounts, followed by the increase in rent expense after the third year, and the salary bonus. We can format these new fields a little to match the initial structure. Now, we have the assumptions ready. Before we start creating the financial statements, we will follow an additional step. A good idea is to create a sheet for the calculations, so it is easier later on to create the financial statements. The idea is still that any later modification will be accomplished within the assumptions sheet. However, adding a sheet for our calculations is much clearer, and yields less errors. As we noticed in class, we could redefine the reference of a cell from the reference box at the left top corner. We bring focus by clicking, and choose the name we want. Once a name is given, no other cell can be called the same, because every reference should be unique. One of the advantages of this approach is that the reference becomes usable across the whole workbook. Thus, no need to navigate between sheets later on to locate a cell that we've given a name. As long as the field is one of its type, it is a good idea to give it a name. In our assumption sheet, all numeric cells are unique, and thus, they can be all renamed. I will come back to this point later on. In our feasibility study, however, we are not going to redefine any cell reference for clarity reasons. That is, B3 will remain B3, and we will use the dollar sign when we want to use absolute referencing. So, we start by creating the new sheet and renaming it to Calculations. The first thing to do now is to navigate back to the assumptions sheet, and start one by one. First, we have the product information. We cannot build on these assumptions alone, so we move next. The second assumption is about the revenues. We have information about sales. Our study is for 5 years, and we have to forecast the sales for the same period. We will start with year 0, which corresponds to the initial start-up year, and then add the 5 years. We have 2 products, their selling quantities and prices. We create 2 fields for each product, and another to calculate the yearly sales. We start with the laptops. We first plug in the price. Prices are fixed, so we refer to them with absolute form. We refer the quantity of the first year. We know that it will double each year. That is, we have to multiply it by 2. But, what if we want later to see the effect of 150% increase in sale on our study? Then, again, we have to change the numbers. To solve this, we add another field in the assumption sheet, and we call it increase in sales. Afterwards, if we want to see the effect of 150% increase, we just change this value. This was another example of how to change to dynamic. We multiply the sales of the second year by the increase. We refer to this increase in absolute terms as it is one unique value, and copy and paste to fill the additional years. Now, we get the yearly sales by multiplying price by quantity. We apply the same for desktops. To make the study looks further dynamic, we could have separated the increase in sales and created different fields for the increase in sales of desktops and laptops. We add a field for the total sales of the company, and add the sales of laptops and desktops together. Finally, we apply some formatting. We move to the second main assumption, purchases. Same concept of sales before applies. We just need the cost and purchase quantity. To save time, we copy from above as it is exactly the same structure, and then delete just the values and not calculations because it is the same formula. We also change names whenever necessary. The costs do not change, so we do as before and refer to them in absolute form. Then, we insert the quantities for the first year. Since purchases are tied to sales, we can use the same percentage increase in quantity as for sales, or for more dynamics, we create additional field for purchases increase. The point is that we don't want to add any static numbers in the calculations. Now, we calculate the second year purchases quantity as the first year multiplied by the increase, and copy into the remaining years. By now, we have the sales and purchases forecast so that we can look into the inventory. Inventory can be calculated per items as we did before, or just as amounts in the case where the sales are given as figures with no items. We first create the title. Inventory for the year will be the total purchases of the year plus the remaining stock. As before, we start with the laptops. We first use the purchases. The remaining stock can be easily calculated by subtracting the sales from purchases. In the first year, we bought 230 laptops, and sold 200. How many do we still have? The difference, which is 30 inches this case. The remaining stocks in year 0 is 0. Total inventory is equal to what we purchase plus what remains from the previous year and not the same year. For year 0, and since there is no year before, inventory equals purchases. We multiply this total by the cost to get the inventory in euro values. Now, we get the inventory in euro values. We apply the same to the desktops. Last, we add the two sub-items to get the total inventory value in each year. Since we started with one balance sheet item, let us continue with the accounts receivables and payables. We first create the titles, and create one field for each. We know that receivables are 20% of yearly sales. We estimate our receivables based on sales, because we receive for what we sold. We just plug in the value, and use absolute reference since it doesn't change. We know that payables are 75% of yearly purchases. We estimate our payables based on purchases, because we pay for what we received. Again, we just input the value, and apply some formatting afterward. Now, we move into the next assumption. Regarding the rent, although prepaid rent is recorded on the balance sheet, and rent expense on the income statements, they have the same values, and thus, we can use one field for both. First, we create the title. Then, link the value to the one we have, and copy into the second and third years. After 3 years, the rent increases, so we apply such increase. We move back into the assumptions sheet, and look into the payroll. we create the title first, and then add the 3 employees. We use the same formula we showed before. Remember? We don't want to include static values, but 12, which is the number of months in the year, is static. Since this value is fixed, I don't see an added value in creating a dynamic field for managing it. If we do need to increase or decrease the number of months later on, we can choose different values for the bonus that can accommodate for such change because it is dynamic. Here, what is important is that you have to decide on what should be dynamic. So, we apply the same formula as before. We multiply the monthly salary by 12 and then by 1 plus the bonus rate. We do the same for all employees. Last step is to create the total, and format the table. We move again to the assumptions sheet. We have the depreciation. This will be the last step in our calculations as the last assumptions don't require any calculations. So, we create the titles first. Here, we need 3 fields: car, depreciation expense, and accumulated depreciation. The car value doesn't change, so we refer to it in absolute terms. To calculate depreciation expense, we multiply the car's value by the depreciation rate. Last, we calculate the accumulated depreciation by adding the depreciation over years. Now, we apply some formatting. And we are done with the calculations. Please pay attention carefully. I've missed one important calculation to show you that we could have applied all these calculations in the financial statements directly, but the approach we followed is clearer and much better when it comes to tracking errors. Additionally, it will help us in the additional calculations. Now, we create the financial statements. To save time, we use the structures we built in class. Now, we have all the 3 sheets with minor modifications. All we have to do is to fill them with numbers. As you remember from last class, the easiest financial statement to start with is the income statement, because it is not dependent on other financial statements. We just need to fill in the values. First, we refer to the total sales that we have already calculated. Then, we move to the cost of goods sold. We navigate to the calculations sheet to see whether we have already calculated it or not. As you can see, we don't have such values. Remember that I just mentioned that there are some calculations that are based on our assumptions and still not completed? That is what I was referring to. Calculating the cost of goods sold is simple. We just multiply the quantity sold by the initial cost and not the selling price as we do when calculating sales. We type the formula which is equal to the quantity sold of each product by its relevant cost. We move forward with the other assumptions. We insert the rent expense. Then, we add the payroll. Next, we add the depreciation expense. Finally, we multiply the earnings before taxes by the tax rate that is given in the assumptions sheet. Now, we just copy the cells into their adjacent positions. We redefine the borders. And we are done with the income statement. We move next to the balance sheet statement. The items that are highlighted in light yellow are dependent on the other two financial statements. We derive cash from the cash flow statement, and retained earnings from the income statement. As we did before with the income statement, we start by typing in the reference cells. We start with the cash. The value here is equal to the cash at the end of the year we will calculate in the cash flow statement. We already calculated the remaining items, so we just refer to them starting with the accounts receivables. For the retained earnings, we just refer to the net income in the income statements. However, this value is retained in the company, and thus, it is carried forward. To account for this, we created a field and named it cumulative retained earnings. It is equal to this year retained earning plus the previous years. Again, we redefine the borders. And we are done with the balance sheet statement. Last, we move into the cash flow statement. We first plug in the cash at the beginning of year 0 as given in the assumptions. The cash at the beginning of year 1 is equal to cash at the end of year 0. Right? And the cash at the beginning of year 2 is equal to cash at the end of year 1, and so on. We get the net income from the income statement. We could also get it from the balance sheet. Now, it is very important to understand how the cash from operating activities work. Think about a case where your inventory increases by €1,000. The first accounting assumption is that you received the new stock for cash. Thus, your cash decreased. That is, an increase in inventory or any current asset leads to decrease in cash, and vice versa. Let us extend the example. Imagine that later you discover that the new inventory wasn't bought by cash but on account. That is, your accounts payables increased by €1,000. We stated that an increase in current assets lead to decrease in cash, and the opposite holds true for an increase in current liabilities because when you don't have to pay an amount anymore, the accounting assumption is that you paid it in cash and vice versa. In this case, the effect of €1,000 increase in payables is an increase in cash by the same amount. As a conclusion for this example, the inventory decreased our cash by €1,000, and then payables increased it by the same amount. Thus, the effective result of new inventory on our cash is 0 in this example. Since an increase in current assets other than cash decreases the cash we have, we use the minus sign in front of the variations in these assets. Thus, if accounts receivables increased for example, the effect on the cash will be negative because the numerical outcome will be negative and vice versa. Now, we insert the formulas into their relevant cells. We can do it based on our balance sheet or directly on assumptions. I will use the balance sheet. Now, we add back the depreciation because if you recall from last week, the depreciation is deducted from our net income. We add it back because in reality, the amount specified for depreciation doesn't physically count and thus, is still within the company. As discussed in class, depreciation is good for companies because it allows for lower taxation. It is also good for the government because it keeps the economic cycle running. We move and refer to the car's value only in year 0, because we buy it only once before starting the operations. We redefine the borders, and that is it, we are done with the financial statements. What is most important now is to check whether the balance sheet closes or not. Fortunately, it does not, and this allows us to see how to track errors. First thing to do is to subtract total liabilities and owner's equities from total assets to see whether the numbers make sense. As we can notice, the difference is the accumulated depreciation. In this case, it is relatively easy for us to track the error. We look first at the calculations that include depreciation in our balance sheet. It is correct. Now, we move and look at the income statement and check with the totals after the depreciation is included to see if it is accounted for. Again, all is good, so we move into the cash flow statement. Here, we find the error. We forgot to add the depreciation to the cash at the end of the year. We add it, and look whether the problem is solved. Now, all is good, and the balance sheet closes. And we are done with the financial statements. So far so good, but how do we know if the project is feasible or not? Before we answered the question, we noticed that in the calculations sheet I made, the years are denoted by 0, 1, 2 and so on, whereas in the financial statements we did together, they are denoted by 2016, 2017 until 2020. Would this make any changes? Although it is always better to use a consistent structure, the direct answer to this question is no. My idea is to get you familiar with the count of the year and not its name because this is more important. For calculating the net present value, we use exponential and hence, it is better to use the count of the year in order. We will see later how. Now, we try to answer the question. In order to see the feasibility of the project, we must look into its net present value. Calculating it requires discounting the cash flows, but what cash flow should we use in this case? Is it the cash flows from the cash flow statement? No, because the cash flow statement shows us the variation in cash only. What we need to look at is the outcome of the project. The income statement sounds reasonable, but the problem is that it doesn't count for the initial cash outflow. Additionally, at the end of the last year of operations, which is year 5 or 2020 in our example, we need to close the accounts of the company because this generates cash inflow or outflow. We close them because we are looking at the feasibility for a definite period of time. All in all, we have to create what we refer to as investment cash flow statement. The process is straightforward. First, and in order to save time, I've created the statement. Let us go through it. First, we have the same 5 years structure. We have investment outlays which corresponds to what we invested initially in the company. We know that we started the company with €50,000, but we need to specify the amounts. First, we have bought a car, so we insert the value of the car in here. NWC is the net working capital. It is calculated by subtracting current liabilities from current assets. This financial measure is widely used in corporate finance. It reflects the liquidity of a company, or more precisely, it shows the ability of a company to meet its short-term debt. If current assets are more than current liabilities, the net working capital is positive. and reflects a healthy financial situation in the short run. In our case, we use the net working capital to show the movement of investment cash flow. Let us plug in the value. We define it as current assets in year 0 minus current liabilities. As you can notice, the net cash flow is just what we initially invested in the company. For the operating cash flow, we use exactly the same as in the income statement. We get the earning before taxes. To obtain taxes, we do the same as before with the income statement, and multiply EBT by the tax rate. Now, we have the net operating profit after taxes. Now, unlike in the income statement, we directly add back the depreciation since it is not a real current cash outflow as explained before. Note that in the standard cash flow statement, we do add back the depreciation too. Now, all what we still have is the terminal year cash flow. First, the net salvage value is what remained of our fixed assets after deducting the depreciation. In our case, we only have a car that fully depreciated in value. Thus, the net salvage value is 0. We refer to it from the balance sheet. Second, the return of net working capital is again just current assets minus current liabilities. The idea is to get what we will still have after paying our current debt. If our short-term debts are more than our current assets, we will have a negative result that will decrease the cash flow at the end of the year, and vice versa. Anyways, we do as before and deduct the current liabilities from current assets to get the value. That is it, we are done with the investment cash flow. Our last step is to calculate the net present value. To do so, we create a new sheet and rename it to NPV and IRR. We first define the headers as year, cash flow, and discounted cash flow. We first fill in the years. Let us have a look at the transpose function. As you can notice, we transposed the row into column without losing the formulas. For the cash flows, we just relate them individually since they are in row, while we need them in column format. We cannot use the transpose function because the fields contain calculations for variables other than themselves. Now, we have to calculate the discounted cash flows. We discount cash flows into the initial year or year 0, because we need to compare values of the same type. $500 today are worth more than the same amount in 1 year from now, because in its simplest sense, we can invest this dollar amount in a bank account and earn interest. Thus, in order to bring the future values into present, we need to discount them. To calculate the discounted cash flows, we need a discount rate which is not given in our example. So, what should we do? Well, whenever you are faced with a scenario where you are not certain about one thing or another, make assumptions. In our case, we will assume that the discount rate is 15%. Although we can make the assumption on the sheet, it is much better to include it with the assumptions. Anyways, the other sheet is not far from here. Let us make this last assumption. We navigate first to the assumptions sheet, and add the discount rate to the end. Let us also redefine the reference to discount rate. The calculation of the discount rate is beyond this class. All what you have to remember is that it is the required rate of return for our project. In other words, given the market conditions, our investment should at least yield this return. Now, we navigate back into the last sheet. As you remember from class, we discount cash flow by dividing it by 1 plus discount rate to the power of number of periods, which would be the year in our example. We apply the formula. Now, the sum of the discounted cash flows is the net present value. As discussed in class also, there is a built-in function in Excel to calculate the net present value. It is however problematic because it doesn't take the initial year into consideration, and starts directly with the first year. To overcome this issue, we use the function for the first year onwards, and then, add or subtract the initial cash flow. Last of all, we look at the internal rate of return. The internal rate of return or IRR is that rate at which the net present value equals 0. We can use trial and error to find this value. We can try higher discount rate. If the value is still far above 0, we try a higher one and vice versa. Let us look at one example. It will be a little tricky because the discount rate is on a different sheet. Nevertheless, we can copy the value of the NPV into the assumptions sheet to see direct variations. As you can notice, the IRR is too high and somehow unrealistic, but it is okay as an example. As we set the discount rate to the IRR, the net present value becomes 0. Thus, we have to set it back to the assumed rate. Another alternative is to use the built-in Excel function. We plug in the undiscounted cash flow into the function, and we get the exact value of the IRR. As you can notice, the value we observed by trial and error is the same. That was it. Based on the results, the net present value is positive, and the investment is feasible. At this point, I want to mention one thing and leave it to you. If we navigate back to the assumption sheet, we would notice that there is one item which wasn't included in any of our calculations or sheets. It is the registration cost paid up front. This will be explained in class, but for those who can't come, these costs don't have a fixed structure. You can include them under fixed assets in the balance sheet in year 0 and carry the value forward to the other years, or under expenses in the income statement in the first year. This solely depends on the type, size, and accounting policies of the company and the country it is operating in. Anyways, I will leave it up to you to explore further. You can choose how to include it, and see its effects on the financial statement. Before I close, I want to see whether our study has no structural mistakes. To do so, I am going to change all the assumptions, and then look at the balance sheet. So, we start by changing the assumptions. This is called sensitivity analysis. It is also called scenario analysis. You have it all in your study. Following dynamic approaches save too much time and efforts. As you can see, the balance sheet still closes no matter how I change the assumptions. All what I hope now is that you have learned at least one new thing from this video.